Thank you very much, Reed. I really appreciate the opportunity to come here and talk about the subprime virus. And it's exciting to be at the foundation. I've never been here before, although I've been a fan for a very long time. Reed asked me to talk a bit about the origins of the book and what it was we were detecting in our research on lending. In 1999, my family lived in an inner ring suburb of Cleveland, Ohio. And at that time, predatory lending was really in its infancy in the rest of the country. But in Cleveland, it was thriving. Brokers were targeting people, particularly in communities of color. As some of you know, Cleveland has some very nice inner ring suburbs that are racially diverse. And they were betting on the fact that because of the history of discrimination in the United States, that there was pent-up demand for credit and that there would be borrowers who were looking to take out mortgage loans. For people like my family that lived in a racially diverse neighborhood, mortgage brokers were constant pests. My daughter is here traveling with me, and she periodically would answer the phone, and it would be a predatory mortgage broker, and she would say, "I know you're a predatory lender," and hang up. And that wasn't because I trained her. They just got used to the calls. But they would send flyers to us. They would knock on our doors. They would call at dinner time. This was before the do not call registry. And their favorite targets were vulnerable people. And in many of the suburbs of Cleveland, there were housing ordinances that were very strong, where your house got inspected on the exterior, I think maybe every 7 or 10 years. And you always got dinged for something. It could be one shingle was loose, or it could be something much more dramatic, like you need a new roof or a new porch. So they would go and they would find the records, and it was like a miracle. The day after you got cited by the city for a housing code violation, there would be this charming broker at your door offering not only to arrange a loan for you, but to connect you with a home repair contractor. They found out they discovered women who had recently lost their husbands through the obituaries, assuming that these were good targets because maybe the women weren't so involved in the family's finances. And basically, you know, the strategy was find people who might be vulnerable and then target them with these loans. Most of the loans during this period, we're talking the late 1990s, were made to people who had a lot of equity in their homes. They had equity either because they were senior citizens and had lived there for a long time, or they were homes that they had inherited from family members. But there were people who usually were income constrained. And the way the loans were set up is that they were really backed by the equity in the loan. They weren't affordable loans from the get-go. And then the brokers would refinance the loans over and over again until there was no equity left in the home. And with each refinance, the brokers would get more fees. So we saw this phenomenon and couldn't understand it. And other than some community groups, there was not a lot of discussion about this kind of lending activity, in part because it was very much isolated to certain parts of the country, parts of Pennsylvania, Michigan, Ohio. So the questions that we were trying to answer were how could brokers sustain these practices? How can you have a business model that's based on people eventually losing their homes? Why would lenders fund loans that ultimately were going to lead to foreclosure? And what had changed in the mortgage market to create space for this type of lending? And questions also about borrowers. Why were they agreeing to loans like this? This is during a period of time where credit was becoming more and more available. Why would they go this route as opposed to more traditional and hopefully more responsible lenders? And then there were the questions about the government. Where were the government regulators as this industry was booming? And what were the roles of the financial markets and of investors in mortgage-backed securities in terms of creating and financing this market? So for over a decade, through our research, we tried to answer these questions. This started as really as a book group. We had a book group of 2 people who said, the 2 of us said, we're going to sit around over the summer and figure out what's the law and economics of this phenomenon, and we haven't stopped since. So during the same time that predatory lending was starting to take hold in other parts of the country, it started to expand, it also started to morph from fringe lending by small companies to mainstream products marketed by the largest financial institutions in the country. And sometimes this marketing was direct, but most often it was through subsidiary organizations. So the big subprime lenders, you would recognize their names, but for many of you, you wouldn't know that actually they were owned by HSBC, Citibank, I mean, you name it. I don't want to target anybody in particular. But almost all the lenders who engaged in the really egregious lending behavior were owned by major commercial banks or investment banks. And the reason for this was what finance economists call vertical integration. Vertical integration is a way of structuring a firm so that you can streamline the process, in this case, of securitizing home mortgages. So banks wanted to have securitization factories, and to have a securitization factory, you had to generate loans to securitize. So they started to buy lenders, and if they didn't actually buy a lender, they would establish some type of a formal relationship with the lender. The other big change in the market was that the loans in the early predatory lending era were very much equity-based loans. And over time, as housing prices continued to go up, the loans were made more on the expectation of a rise in home values and also based on people's incomes. So, and at the same time, there's another phenomenon, which is that the loans became ever more complicated. That's when we started to see teaser rates and pay option loans and other terms that masked the fact that the loans were unaffordable. So we all know what happened. In 2006, the mortgage market started to crumble, or at least started to tremble, and crumbling came next. And the first few chapters of the subprime virus really tell the story of what happened up through 2006. So it tells the story of the beginning of the predatory lending market and then up through the time that problems began. And we describe what was happening, as Reed said, both from a neighborhood level up through what was happening at Congress, the Federal Reserve, and Wall Street. The first line of the book is, "Hope doesn't come easy in Cleveland." And we end with where Cleveland is at now, 12 years later. Then we go on in the book to describe the crisis as it unfolded. Everybody remembers all the scary headlines in the newspapers and things like that, but we chronicle exactly what was happening, the problems that were brewing, how the government was responding to it, how the market was responding to it, what was happening around the world. And our goal in these chapters was to tell a complete story, a story that integrated policy, understandings of financial markets, some behavioral markets, and stories of real people. The book is a pretty easy read, but I have to warn you, the type is small. In many ways, what we were trying to do in the book was to answer the questions, who knew what when, and what did they do about it? And it was in this vein that we also took on the role of the federal regulators. As many of you probably know, there were states and some cities that tried to curtail abusive lending early on by passing anti-predatory lending laws. They encountered formidable obstacles, most notably lawsuits that restricted their ability to stop the abusive lending that was polluting their neighborhoods. What many people don't know is that the federal regulators had the power to stop this high-risk lending, and they chose not to exercise that power for many years. And the book goes through a lot of different examples. I'm going to highlight just a few. In 1994, Congress passed the Homeownership Equity Protection Act, and in it, they required the Federal Reserve Board to use its rule-writing authority to prohibit unfair and deceptive mortgage practices. Alan Greenspan refused to follow this congressional mandate. Equally concerning, the Fed was charged with supervising bank holding companies and their subsidiaries, including HSBC, Citibank, Countrywide, and they chose not to examine the subsidiaries until 2007, long after the cows had left the barn. In 1990, the SEC chairman, Arthur Levitt, and Alan Greenspan, and two Treasury secretaries, Robert Rubin and Larry Summers, endorsed deregulation of credit default swaps. They are the very instruments that brought down AIG, and but for the taxpayer bailout, would likely have collapsed the world economy. Not until 2006, following the Enron crisis, did the federal government begin regulating the credit rating agencies and in any meaningful way, and even then, it was very much regulation light. These rating agencies gave the good housekeeping seal of approval to dicey bonds, and the government did nothing to limit this practice. If you want more examples of the government lapses, as Reed said, the book is available at your local bookstore, and if it's not, you can request that they order multiple copies. Moving sort of fast forward to today, there's been a great deal of press about how the policies of the federal government may have spurred the financial crisis. Some people, including the dissenters to the recent report by the Financial Crisis Inquiry Commission, take the position that the federal programs that encourage lending to low and moderate income borrowers were the cause of the crisis. And they often, in these arguments, cite the Community Reinvestment Act, which grades banks on how well they meet the credit needs of their local communities. High CRA grades can be important to banks' ability to expand, for example, to acquire another bank or to become a bank holding company. And critiques of CRA claim that this law created an incentive for banks to make high-risk loans, and that then led to the financial crisis. And so one of the things I think that's important to know is that there has been extensive empirical research looking at this precise question. Did the CRA play a role in causing the financial crisis? Did it create incentives for banks to make high-risk loans? And all the empirical research has found that no, the CRA was not responsible for the financial crisis. Another argument has been that Fannie Mae and Freddie Mac, the two government-sponsored enterprises that are now in conservatorships, were the source of all evil. Fannie and Freddie, for starters, are not lenders. Their primary activity is purchasing loans from lenders that they then convert into securities. Fannie and Freddie are connected to the government because they receive certain financial privileges in exchange for meeting HUD-imposed targets for purchasing loans that were made in low and moderate income communities and to low and moderate income borrowers. It is this connection that has raised outcries that the government's affordable housing goals were the cause of the crisis. The reality is that Fannie and Freddie were at the vanguard when it came to stifling abusive lending. Early on, they adopt some of the strongest anti-predatory lending rules, and these rules were lauded for many years. And the rules prevented Fannie and Freddie from buying loans that contained certain types of abusive terms or that were the result of abusive practices. As we know, it's not all good news with Fannie and Freddie. Over time, subprime lenders began marketing their products to people who would have been better off with conforming loans. Conforming is a term that we use to describe the loans that meet Fannie and Freddie's criteria. So subprime lenders lured borrowers who could have gotten cheaper loans that could be sold to Fannie and Freddie into loans with teaser rates and adjustable rates that appeared more affordable, but in the long run were not. So as Fannie and Freddie continued to lose market share, they too relaxed their underwriting standards and began participating in the race to the bottom, which is where they are now. Fannie and Freddie did play a role in the subprime crisis by purchasing risky loans, but it was only after other lenders had flooded the market with these types of loans. But what's clear from this history is that Fannie's buying practices were not the impetus for the high-risk lending, and they only joined the fray late in the game. So at this point, you may be thinking this is a pretty depressing book, which it is in part. But there's hope. And where we get hopeful is when we look at the new financial reforms under the Dodd-Frank Wall Street Reform and Consumer Protection Act that passed in 2010. Just as an aside, in the category of be careful what you wish for, we really wanted to see some government reform of mortgage lending, and we finished the book last spring, and then Congress passed the law, so you know how we spent our summer. We had to spend the whole summer absorbing the new law and writing several new chapters to the book. The Dodd-Frank Act is grand in scale. It creates the Consumer Financial Protection Bureau, which is charged with regulating an array of credit products, including mortgages. The law requires that borrowers have the ability to repay any loans that they take out. It attempts to limit the mortgage confusopoly. Confusopoly is a term that Scott Adams of Dilbert fame coined, by simplifying products and improving the disclosures. And the law eliminates some of the incentives for brokers and lenders to push borrowers into higher priced products. Dodd-Frank also attempts to make securitization markets safer by creating mechanisms that allow investors to evaluate the risks associated with different financial instruments. The Act promises to eliminate bailouts. I think time will tell whether this is aspirational or an actual commitment. The law implements an early warning system that will set off alarms if systemically important institutions are at risk of failing. And it does attempt to regulate the credit default swaps, which ended up being somewhat toxic in this market. This is an area where I think Dodd-Frank doesn't go as far as it should, and I'm happy to talk about that a bit in the discussion period if people are interested. The Dodd-Frank Act is not a panacea. We still have some work to do. The future of Fannie Mae and Freddie Mac is still unknown, although we certainly know that it's not going to exist in the future as it did in the past, or either of them did in the past. Questions that have to be answered, and thankfully Raphael will have some wisdom in this area, is, what's the role of the government in financing loans in the future? What's the role of the government in regulating any entities that ultimately take on Fannie's and Freddie's tasks? Should guarantees on loans be from the government or through private guarantors or insurers? There are a lot of questions to be answered about interest rate risk. We certainly are all pretty committed to the 30-year mortgage, but that means somebody has to bear the risk of changes in the interest rate. Who should bear the risk of those changes? And what are different ways to allocate that risk in a way that will allow people access to credit? Should we be thinking about federal programs as being as counter-cyclical, where the government steps in with more support during bad times like now and retreats from the market more during good times? Can we avoid too big to fail when we recraft the functions of Fannie and Freddie? And then there are a lot of questions about home ownership. I think most people would agree that less home ownership is better than more home ownership at this moment in time and given the recent experiences. But if we're going to move somewhat in that direction, then we have to make sure we have a good stock of rental housing, that people can get long-term leases, because one reason people buy is because they don't want to be have to move. And then we need to think about how we make home ownership more fair. For example, do we want to start allowing a mortgage interest deduction for people who don't itemize, so that it's not just affluent people who get that benefit? We need to adopt strategies that address sustaining home ownership, pre-purchase savings plans so people aren't totally out on the edge when they go to buy a house, emergency loan funds for low and moderate income borrowers who don't have money to tap when a boiler goes or something like that. Maybe we should be looking at insurance against interest rate changes for borrowers, where they could actually buy insurance so that they don't have to bear the risk of changes in interest rates. Other problems that we need to address is what's happened to our communities. We have communities that are littered with vacant homes that drive down property values and are often cover for unlawful activities. We also have social consequences we have to address. Families have been dislocated and separated. Children's educations have been disrupted. Some of you may have seen the reports that schools are now changing their curricula instead of being based on, it's going to be a 2-month unit on Egypt. They're doing it in like 2-week segments because there's such a change in the students in the classroom at any given time. People have lost important connections to their emotional communities, the people who give them support, who provide childcare when a kid gets sick at school, who are contacts for jobs. People are losing their connections to places for spiritual comfort. So all of those problems we're going to have to address. This is not the problems we're facing right now are not simply ones of how do we finance the housing market. My final thought is that people are mistaken when they describe the financial crisis as a perfect storm. A perfect storm suggests a rare confluence of events, and that is not what happened. The financial crisis began as a virus in neighborhoods like those that we saw in Cleveland and eventually infected the world economy. And to borrow from Camus, a virus never dies or disappears for good. It can lie dormant for years and years, and then, for the bane and enlightenment of men, rouse up its rats again. Thank you.